Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. Yes, it's not about getting retired. It's about staying retired. We don't want you to survive in retirement. We want you to be thriving in retirement. And that means a plan, an integrated approach to your wealth. You deserve and need to work with a family office. A family office is exactly that. It's all the services that your family needs end to end under one roof. That's the cash flow modeling, the financial planning and discipline, the registered investment advisor services, the tax side, the estate side, the retiree healthcare side, the long-term care side. You put all of it together. That's a family office experience, and round it off with trust services. We can get it done. 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretiredstayretired.com. So what are your takeaways from this week? I know you know that the Federal Reserve cut rates. I know that you know it was the most anticipated Fed meeting in more than a year. But what does it mean for your money? What should you be doing? Well, that's what we're talking about right now in the A block on a Sunday morning. So you heard it. The Fed gave you a cut. And what was the cut? It was just 1/4 point. But the messaging was that more cuts are likely coming. So what's your takeaway from that? Well, your takeaway should be, is the Fed cutting because inflation's under control? No, clearly it's not. Some of the inflation data is still running a little hotter. I don't need to tell you that. You're a consumer at the grocery store just as I am. But why is the Fed cutting rates now? They're cutting rates because they see what you feel. They see what is in the data. And the data is showing that those who are currently unemployed are taking a lot longer to get reemployed. And the data is also showing that we are in a position right now where it's a very low hire and a very low fire. And then what does that translate into? We eventually go into zero hire, and you know what comes next. So the Fed's hoping that these reductions in interest rates are going to keep this economic engine going. How does the economic engine go? Well, a big part of it starts with housing. Yeah, newscast, in case you didn't know it, mortgage rates are at 3-year lows. That's right, 3-year lows as of the recording this morning. So if you have a mortgage that starts with an 8, yep, some people got up there. You got a mortgage that starts with a 7. Oh no, you can have 6 1/4 or less on a mortgage right now. Get out there and maybe consider refining. For everybody else who's looking to purchase, you know what? An adjustable rate mortgage, boy, I never say that, but an adjustable rate mortgage might be okay because it's likely that we're actually going to have more interest rate cuts, not less in the future. Well, those are things you need to be thinking about if you're a borrower. Now you know the reason the Fed cut rates. It's all about jobs and some of the losses, the job losses that are going to come. But what do you do with the rest of your portfolio, that 401k, that 403b, those IRAs? Well, first, hopefully, you've already done what we've been talking about for what seems like weeks, if not months. Hopefully, you've already been locking in your bonds because you want to lock in the interest rates before they get lower. And that meant building out bond ladders, bond barbell, bond bullet strategy so you could lock in those yields before they start going the other way. The second thing that people needed to be thinking of, we've talked about this for weeks and months as well, is we've been saying it's last call, it's last call, it's last call. Well, listen, it's not just last call. Last call happened and the lights are actually on now. You need to make sure you're extending the duration and not just hiding out in cash. You can't just hide out in high yield savings and money markets. All those used to be 5%, then they went to 4%. I got news. They're all heading on a one-way ticket right now to 3% and change. So you got to find more creative ways to generate and stash that cash, especially when the most recent inflation data was still running at 2.9%. Now, pause there. What else? Well, there's a lot else. So I think about, if you're just joining us, we're talking about the Fed. We're talking about the rate cuts. We're talking about the reason for the rate cuts, which is ultimately jobs. They're trying to get in front of what is going to be a more difficult job market in the future. Now, is that difficult job market I'm talking about the type of job market where it takes longer for people to get a new job, the type of job market where more people fall in the unemployment line? Is that indicative of some bad economy? No, it's much more indicative of the transformative change that we're currently going through in this country. And what is that transformative change we're going through? Well, this transformative change makes things like the PC revolution, the personal computer revolution, look like a walk in the park. It's going to make the internet revolution look like a walk in a park. It's going to make the energy renaissance that we experienced in the US, where we learned to drill horizontally, unleashed all of that shale oil, made America energy independent, made America a massive exporter of energy. It's going to make that look like a walk in the park. And what am I talking about? I'm talking about the transformational nature of artificial intelligence. I'm talking about the fact that everyone's going to wake up in 2027 and say, what just happened? It'll have already happened. That's 15 months from now. Everybody listening, 15 months from now, the world is going to look different than it is today, because of how powerful AI is. That's the reason for the rate cuts. That's the reason to get in front of the jobs market. And that is the reason why, as we talked about in this first segment, you should have already lengthened the maturities of your bonds. You should have already locked in some coupons. You should have already bought additional treasuries. If you had an old annuity, you should have already upgraded the annuity. Or if not, it's still not too late. You should look to do an annuity upgrade. But away from that, I think the investment message is, what are you doing to make sure that you're investing for the principle of scarcity? Because if artificial intelligence is going to come through and reprice labor, artificial intelligence is going to come through and unlock all of these changes, these long-term secular, if not seminal changes, then I think investing in AI, that doesn't just have to be investing in AI chip stocks. That can be investing in all things that are powering AI. And what's powering AI? Well, it's the data center. How can you invest in data centers that are going to continue to need to be built to grow, to scale, to keep up with AI? How can you invest to participate in the way the data is going to leave that data center, which is through satellites? Yep, satellites, cell towers, and fiber optic networks, because the data center is useless unless it's connected. How else are you going to participate in this AI revolution? Through this principle of scarcity. Well, it's not just the data center, the cell towers, the satellites, and the fiber optic networks. You're also going to want to own the power, because a next gen, current gen, leading gen, or hyperscale data center requires such tremendous amounts of power. So how can you be participating in liquefied natural gas, localized district heating and cooling, participating in all forms of energy creation? I think those are endurable themes that fit this principle of scarcity. And if you want to learn more, you can, and I think you should. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Or pick up the phone and give us a call at 833-964-PLAN. That's 833-964-PLAN. Getretiredstayretired.com. Take advantage of a complimentary consultation with myself. Yes, if you listen to this radio program, I want to connect with you. Or you can connect with your choosing, one of the other advisors inside VestGen Wealth Partners. But if you listen to AM radio and you listen to Salem, there's probably an awful lot of commonality that we have. And I think that's important to work with a like-minded advisor. And what are we going to do? We're going to get together and talk about what it means to have real return investing. We're going to talk about what it means to be going through this transform. I mean, this is our industrial revolution. Artificial intelligence is our industrial revolution. It is so much more significant than any of the other things that I mentioned. It's more significant than the PC. I think it's more significant than the internet. I think it's more significant than the energy renaissance, and you should be prepared, and it should be reflective in your portfolios and your strategies so you too can not just get retired, and stay retired, but so that you too can not just survive. You deserve to thrive in retirement. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. All right, when we come back, we got some more sincere and actionable ideas that you're going to be able to use to improve the lives of yourself and your loved ones financially. You're listening to who? Me, Craig Bolanos, in the know. VestGen Wealth Partners, AM 560, The Answer.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
So I want to talk a little bit about the 7 deadly sins of wealth management. Oh my gosh, what is that? The 7 deadly sins? Well, you know what those are, but I think of it from more of a wealth management perspective. There was a great article that I saw running out there from one of the websites. I think I might have seen it on Kiplinger, but it talked about these 7 sins. And the first one that spoke to me is not starting with purpose. And sin number 1, when it comes to investing, when it comes to wealth management, is not starting with purpose. We talk all the time that you can't just be invested. You can't just be diversified. You need to invest with a very specific purpose and a specific goal in mind. And when you do that, you find that you're narrowing the focus to increase the impact. And you know what that does? That drives your results. That drives your alpha, investing with a purpose. So don't get caught in sin number 1, which is not starting with a purpose. Be purposeful, be intentful in everything that you do. And when you are incredibly intentional, the results, they tend to accelerate. And we can help you do just that. All right, number 2 on my list of 7 deadly sins inside of investing and wealth management group is starting this destination. Maybe it's this destination of retirement, but doing it without guidance. I mean, listen, we're in a world of DIY, do it yourself. And there are so many things that we can go and do on our own. But if you're going to get retired and honestly stay retired, you can't possibly have any experience with that because you only retire once. So you need to turn to people that deal with it every single day. And that's why I talk about our strategies at VestGen Wealth Partners, our TNT, tested in the trenches, designed to not just get you retired, but keep you retired, because you need to actually have real strategies that work for cash flow, strategies that work to minimize taxes, strategies that actually work to advocate for yourself through your estate and then message to the ones you love, strategies to make sure you're not drowning in overly expensive Medicare premiums for IRMA, income-related monthly Medicare adjustments amount. You just need strategy. So sin number 2 is don't go it alone. Work with a guide. Sin number 3, when it comes to wealth management, investing, is not recognizing that I do think that cash remains king. And where that comes from is, here it's not about having too much in cash. After all, yields on short-term cash reserves are all going lower because of interest rates. But cash is king means not having leverage, not having the debt. Last time I checked, is retirement's about monthly cash flow. And the less debt service we have, the less frequent our payments are every month, the less cash flow we need. So not everybody should pay off a 2.5% mortgage if you're lucky and you have somebody. But by and large, we need to acknowledge something Dave Ramsey says all the time. You want to try to achieve, be, and maintain a debt-free lifestyle, because that's directly supportive of your retirement. Sin number 4. If you're just joining, we're talking about the 7 deadly sins of wealth management or investing. And we talked a little bit about not being intentional, not starting with purpose. We then dove into going on your own. If you're going to retire, again, I say don't do it yourself. Work with people who are experts, who have helped other people get retired and stay retired. Number 3, paying attention to cash and not having all the debt obligations. And that brings us to 7 deadly sin number 4. You don't want to be complacent. It's complacency. And complacency can happen in markets like we've had for months now. Everybody remembers how the year started. It was about Trump-onomics. And January and February were fantastic. And then Trumponomics was quickly replaced with recession paranoia. And gosh knows that was awful. And then recession paranoia was replaced into where we currently sit, which is AI, artificial intelligence enthusiasm. AI enthusiasm is the current market we're in. And when it seemingly looks like everything's working, bonds are raising in price, creating good total returns as interest rates come down. Stocks are hitting all-time highs. We now have small caps rallying after sitting out the rally all year because of the interest rate cuts that are here and the rate cuts that are coming. That can cause someone to be complacent. Don't be complacent. This is a fragile world, a fragile market, a fragile economy. It always has been, and things move swiftly. So you need to make sure that you are disciplined with your allocation. Is your asset allocation and your risk budget in line with your retirement plan? Number 2, make sure that you've got the proper diversification. Don't just be diversified for the sake of diversity. Diversify for a purpose based on when you're going to use the money, how it's going to be taxed, and how it's going to be inherited. Make sure you have very strong rebalancing protocols. You don't want to just do quarterly rebalancing on a calendar. That doesn't make sense. You need to be doing dynamic rebalancing throughout the course of the year, because that allows you to maximize your tax swaps and your tax loss harvesting. And of course, pay attention to security selection. That's right. Security selection matters because price matters. So avoid sin number 4, complacency. As I talk about these 7 deadly sins of wealth management and investing, you might say, gee, I want to learn more. Well, you can. go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Connect with me via telephone, Craig Bolanos, 833-964-PLAN. That's 833-964-PLAN. All right, on to sin number 5. Assuming investments are an end rather than a means. Well, here's how I take that. Things like annuities, they're a tool. They're not a plan in and of itself. An annuity is not an income plan. An annuity is a tool combined with the strategy of your overall portfolio to drive income. What I'm trying to say here is annuities aren't bad. Annuities can be great, but use them for what they are, a tool as a part of an overarching plan. I find too many people that are just buying products. You don't need to buy a product, listeners. You need to be a part of a process, because it's a process that leads to a systematic, repeatable experience. Sin number 6. Sin number 6. I think everybody knows that if you climb Mount Everest, you got to have a Sherpa. No one climbs Mount Everest without a Sherpa. If this seems reminiscent of starting your plan without collaboration, it's meant to, because I think it's so incredibly important that people have a Sherpa. In this case, a financial Sherpa. In this case, a wealth manager. You didn't need an investment advisor. You need a wealth manager, someone who can bring all of these services under one roof, whether you need the services or not today. It's the ability to scale and execute them on demand. That's what's valuable. Sin number 7. Someone said it's buying into the dream, but ignoring the process. You know what I tell everybody? Don't fall in love with your investments. Don't fall in love with the results. Fall in love with the process. So commit to work with advisory teams. Don't work with a solo advisor. Work with advisory teams that have a dedicated, systematic, repeatable process. That's what I want you to fall in love with. Because if you want to get retired and stay retired, and you want to make sure you thrive, don't just survive in retirement, it's the process that gives you the ability to worry less. And you know what? When we worry less, we have the opportunity to live more. And that's what fulfillment's all about. So 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. Take advantage of a complimentary consultation. We're coming up on the 4th quarter of the year. That gives us 90 days to get the ship lined up for 2026. The air is getting a little bit thinner in market conditions, but hey, that doesn't mean a hot rally and a hot economy is not going to continue into 2026. I tend to think it's going to. You just need to make sure you've got the plans and protocols to play defense while you're enjoying the offense and scoring these touchdowns. Well, at least somebody is. The Bears haven't so far this year. Okay, hey, we're going to talk a little bit more about what it takes to be financially successful. You're listening to In the Know, VestGen Wealth Partners, Craig Bolanos, my favorite station. Most people call it AM 560. Those who love it, we call it The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
This is going to come across like a public service message, but it's because it's something that's been rooted in real life, because I saw it for the second time in 2025. Do not, and I repeat, do not inadvertently disinherit your grandchildren. There you go. Do not inadvertently disinherit your grandchildren. Where does that come from? Well, it comes from the hidden risk of retirement account beneficiary forms. What am I talking about? When you have an IRA, you have a 401k, you have an annuity, you have this opportunity. It's an opportunity to name your primary and an opportunity to name your contingent beneficiaries. And here's what if I sound frustrated, it's because I am. Time and time again, people are naming the right people, but not paying attention to the semantics, not paying attention to the details, and it's having unintended consequences where people end up disinheriting more often than not grandchildren. So let me lay it out. Let's talk about how this happens. Remember, guys, retirement accounts, these IRAs, these 401ks, whatever they might be, they often are representing a substantial portion of people's estates today compared to what they used to be. I mean, it used to be all about the real estate, the bank assets, the stock portfolio. Now it's about the retirement accounts, followed by the stock portfolios, followed by the real estate. So this is significant. And estate planning attorneys, they're good. They know what it means to keep the money in your bloodline. The problem is the insurance agent, the 800 number, the forms you signed when you put in your primary beneficiary as your spouse. Great. I like it. It's good. You're married. It more likely than not should go to your spouse. And then maybe you've got 3 kids. I'm happy you listed the kids, a third each as contingents, but you didn't go far enough. See, your estate plan probably has language in it like per stirpes, PER space STIRPES, per stirpes. That means through the bloodline. You got to go back to your Catholic school education, get comfortable with Latin subroots. But most beneficiary forms aren't per stirpes, which is probably what your estate plan is. Your estate plan is to your spouse, then equally to your adult children, and heaven forbid one of your adult children predeceased you or died simultaneous with you. You would want that adult child, if you had 3 adult children, you would want that adult child's 1/3 share to go to your grandkids, aka the kids they blessed you with, and it's not happening. It's not happening because people aren't checking the right boxes on beneficiary forms, or worse yet, the beneficiary forms don't even allow you that bloodline provision of per stirpes. So what are you going to do about it? Well, you're going to call me at 833-964-PLAN, 833-964-PLAN, or you're going to connect with us online at getretiredstayretired.com, getretiredstayretired.com. And we're going to have a very thoughtful and intelligent discussion about what your family tree looks like. And then we're going to go through a financial discovery process to make sure that there isn't any hanging chads. Hanging chads are bad. You don't want to have it held up to the light and have subjective judgment on where the money goes. And if you want that money to go through the bloodline, then there's a real easy solution. It's the right primary beneficiary with the right contingent beneficiaries with the right language accompanying it of per stirpes or pro rata or per capita. And for a lot of people, you might just want to use your trust as a contingent beneficiary. But if you're going to use your trust as a contingent beneficiary, you got to make sure that that trust was expertly crafted, because you want to make sure you're extending the protection mechanisms to save on taxes that are eligible under Internal Revenue Code 401, because that trust has got to be a valid see-through trust. And when you do that, you can put the ones you love in a position to be successful. Let me give you examples of that. We've got 2 boys. I'm married to my best friend in life. Her name is Leslie. And we have 2 boys, Connor and Gavin. They are our adult children. Shout out, super proud of both boys. Connor, he works for the McCain Foundation under the Department of Defense, now branded the Department of War, right in D.C. Shout out to everybody in the Pentagon. Number 2, our younger boy completed 4 years of academic curriculum, is sitting for his certified financial planner designation as we speak. And he's at VestGen Wealth Partners as an associate along with us. But we've been clear. Even though one of our boys is already married, our money goes to spouse first and then goes to our kids equally. And if our children predecease us, but blessed us with any grandchildren, legally adopted or naturally sired, I've got boys. Boys aren't given birth. We want the money that would have gone to our adult kid to go to those grandkids. But we want to make sure that there's strict governance. I don't want those grandkids getting the money at the age of 18. And I want to respect these women. They're called daughter-in-laws that are in our boys' lives. So I want to make sure that money's available for health, education, maintenance, and support to get them through life. I don't want to worry about these monies going to creditors. I don't want to worry about these monies going to death and transfer taxes. I don't want to worry about these monies in so many ways, but it's that trust mechanism that allows it to happen. So if you're just joining us, I was talking not about the art of the beneficiary review, but I was being very focused on a singular topic. Do not put yourself in a position to inadvertently disinherit your grandkids. Because too many people are inadvertently disinheriting their grandkids, not because they've got bad wills and trust documents, but because somebody didn't take the time on the IRA account at the custodian. Someone didn't take the time on the 401k plan. Someone didn't take the time when they filled out the annuity app to make sure they filled out the right box of per capita, per stirpes, or pro rata. Because all of those mean something very, very different. And now you're scratching your head wondering what's on your contingent beneficiary form. Well, if you don't know, you should. And if you want to know, you absolutely can. Give us a call, 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com. See, at VestGen, we're a family office. The purpose of a family office is to bring all of those services in one roof, because your estate attorney should be working in direct concert with your registered investment advisor, who is working in direct concert with a qualified tax professional. And that's what we do, and we do it well. It's providing a much more holistic end-to-end experience to make sure that there aren't any hanging chads, so you too don't have to worry about inadvertently disinheriting somebody. I saw it for the second time this year. And while there's fixes, those fixes are cumbersome, those fixes are expensive, and those fixes don't always get done because it requires a lot of cooperation. So my message, don't let that be you. Okay, you're listening to Craig Bolanos, founding partner, wealth manager, VestGen Wealth Partners. We exist to help people just like you thrive as opposed to survive in retirement. I want you to have an opportunity to use these strategies and disciplines that are repeatable and tested in the trenches, because if you too can fall in love with the process, you're going to worry less and live more. And isn't that what it's all about? So stay tuned. We got more to come after this. AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560, The Answer, where his goal is to pummel you with financial know-how until you say uncle.
I want to talk about this AI disruption. I know we talked about it earlier in the show, but I kind of mentioned it more from an investment thematic, which is how to be a part of it. You know, the obvious thing is to own the chip makers, own the semiconductors. The less obvious portion is to own the data centers that are going to house those chip makers. The less obvious to that is owning the information pathway through which that data is going to be transmitted, the satellites, the cell towers, and the fiber optic networks, to owning even the less obvious, which is the power generation for it. But those are all just investment ideas. And you can absolutely learn how we're dealing and how we're investing in semis, how we're investing in infrastructure, how we're investing in energy. But let's turn this now into another topic, which is think about your family and think about the younger generations and think about everything that could scare you about the AI revolution, about how productive we're all going to be. See, right now, AI is enhancing the human experience. Oh, and it's to be celebrated. I mean it sincerely. AI is enhancing the human experience. But AI is going to, in the future, replace a lot of the human jobs. See, it's already started. I don't know that AI is replacing the jobs, but what companies are doing is they're just going on hiring freezes because they're finding ways to leverage AI instead of hiring new employees. You're seeing in some of the technology companies layoffs of employees so they can free up the capital, which means the money to do the additional R&D to power this. But eventually, the AI is going to be used for job replacement. And you've got to start asking yourself, is my industry at risk? Is my job at risk? Well, the answer to everybody, regardless of what you do, is yes, because everyone's going to be impacted. But then you got to start saying to yourself, if you're at the top of the pyramid, if you're mom or dad, if you're grandma or grandpa, you don't have responsibility for everything else in the family. But maybe you do, because maybe you got people that you know, people that you love, people that you like. You know what they're called? They're called your adult children and your adult grandchildren. And you know what? I was able to go to college and graduate without student loans because it wasn't expensive like this. I was able to fall in love and get married, and we were able to buy a house. And while it seemed prohibitively expensive at the time, I got news. It was affordable. And then we were able to buy a bigger house to hold the family that was ever growing. But this goal of home ownership, it's a long ways away for people now. And it's not because interest rates are high. It's because the price of housing is high, because we haven't had enough construction to keep up with demand. So there's an old saying, if you can't beat them, join them. Everybody jokes that a lot of the real estate in this country has been bought by institutions and private equity firms. I got news. It's true. It has. And I got other news. It's going to continue to happen. All this multi-family housing, condos, they're going to continue to get bought up. And you know what? Maybe you should be investing in those funds so that you can be collecting the income from the rental properties. Now, that's not going to get done in a normal mutual fund. It's not going to get done in a normal ETF. It's going to get done with an alternative investment sponsor. And guess who offers a gateway to institutional alternative investments like multifamily housing, industrial real estate, infrastructure? Well, we do at VestGen Wealth Partners. And those are things I think you've got to consider for parts of your portfolio. But back to what we're talking about with the AI revolution, I think if you are of a certain age and a certain financial stature, you might want to work even harder to secure your financial stature and work even harder to enhance that financial stature, because you might actually feel more motivated than you've ever felt a year and a half, 2, 3, 4, 5 years from now to leave a better nest egg to the next generation. Because I got news, guys. I think they're going to need it. I got news. I think it's just going to continue to get harder and harder and harder. And while AI is going to make everyone's lifestyle great, because I'm eventually not going to do my dishes, I'm eventually not going to take out my trash, I'm eventually just going to let the automated machine cut my lawn and do my weed whacking for me. Seriously, that's all coming. It's going to come at the expense of jobs and scarcity. Everything that we want is going to be more expensive in certain things, especially stuff like housing. What am I offering you? There's no silver bullet for what's happening. What I'm offering you is the opportunity to have conversations about this. I'm offering you the opportunity to learn more. I'm offering the opportunity for you to think bigger, the opportunity for you to plan and strategize 2 steps ahead, only if it's important to you. But part of this conversation tails into what we talked about a minute ago, not the concept of accidental disinheritance of grandkids, which I've seen twice this year, by the way. That's why we talked about that in the last segment. But it's about messaging. See, I don't want you to leave monies to kids or grandkids. I want you to leave monies to kids or grandkids with messaging and governance as to how they use it so they don't blow it, so you too can see them get a leg up to get empowered with education, to start the business, to teach them how to generate passive income without having to deal with the headaches of tenants, toilets, light bulbs, you name it. All of that is possible. So the AI revolution isn't coming. The AI revolution is already here. I said in my opening segment today, you're going to wake up in 2027, 15 months from now, and just be like, wow, how the world changed. And it's going to happen literally that fast. The same speed through which we had the Industrial Revolution, this is the AI revolution. So that means investing in assets that are scarce. Assets that are scarce makes just a heck of a lot of sense to me. And I think there's also reasons to future-proof yourself from the silent killer in inflation, the silent killer in retirement, rather, which is inflation. And part of the inflation that we need to start future-proofing ourselves from is currency inflation. See, last time I checked, the US dollar has grown and grown and grown and grown, or strengthened and strengthened and strengthened in value for so many years. But if you haven't noticed it, the US dollar has given back double-digit ground against Forex, the euro, or other baskets of foreign currency. And you know what that means? Travel and leisure, goods, services that you're consuming that may originate outside of our borders, they're a heck of a lot more expensive than they were in January. And I don't think this is a temporary trend. That does not mean that America's on the decline. It's not. We are still the beacon of hope, the beacon of freedom, this Constitution, this flag, this red, white, and blue, what America stands for is still attractive to everybody around the world. But we're seeing all these other countries no longer want to be as dollar denominated, because they don't want the U.S. to have as much influence. And there's a lot of reasons for that. But you got to be paying attention to that stuff so you can start solving for other forms of storages of value, so that you too can be pursuing real return investing, so that you too can be hedging something you haven't had to think about for the last 20 years, which is currency inflation, which, by the way, isn't coming. It's already here. If you want to learn more, you can and you should. 833-964-PLAN. 833-964-PLAN. Get retired, stay retired.com. That's get retired, stay retired.com.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
I got to do another public service announcement. There's a reason you can't just do everything yourself. There is so much information out there, but information itself is not power. Information harnessed with process is powerful. And here's something. I've been talking about Roth conversions since 2013, but I got news now. Roth conversions could now do more harm than good. Whoa, there's a headline. Roth conversions could now do more harm than good. Why? Guys, We got the Tax Cut and Jobs Act renewed. We got the Tax Cut and Jobs Act expanded. It's called the One Big Beautiful Bill. And under this One Big Beautiful Bill, you know that there's a bonus deduction now for those 65 and older. You know that under this One Big Beautiful Bill, there's an enhanced SALT, state and local tax deduction. Under this One Big Beautiful Bill, there's a number of new provisions. And my concept to people is, hey, Roth conversions, I love them. It's some of the smartest things you can be doing. But if you find yourself in the 10, 12, or 22% tax bracket, the 10, 12, or 22% tax bracket, you got to go with caution because your modified adjusted gross income, that's what it's all about. And I'd hate for people to lose, married couple, $12,000 of bonus deductions. I'd hate people to lose this or lose that. So starting in 2025, tread carefully. Remember I said we do our Roth conversions at the end of each year? Well, this is another great example because if you converted prior to the passage of the One Big Beautiful Bill, you might have actually converted yourself into a sneak attack on income taxes. That's why we'll be starting that process now this fall in the month of October for everybody we serve at VestGen Wealth Partners because the law is in the books. We're far enough along in the year that we can do pro formas of what your taxes are look like and do smart conversions. So bottom line, guys, Roth conversions, they're good. But if you're in the 10, 12, or 22% marginal tax bracket, they could now do more harm than good near term. So you got to work with professionals that are going to help you, which means having multiple advisors or multiple disciplines under one roof. That's what we do at VestGen Wealth Partners. Listen, I hope you love the show as much as I love you, our listening audience. You want to connect? Give me a call, 833-964-PLAN. That's 833-964-PLAN. Get retired, stayretired.com. Get retired, stayretired.com.